Good afternoon, everyone, and thank you very much for attending our webinar on portfolio management. It gives me a great pleasure today to introduce our esteemed professors from Carnegie Mellon University, Qatar, Professor Fuad Farooqi and Professor John O'Brien, who is actually joining us from Petersburg, where I guess it's still early morning there, John.
Yeah. Not too early, but it's morning,
okay.
Yes. Yeah.
Dr. Fuad Farooqi is Associate Teaching Professor of Finance, and Professor John O'Brien is Senior Associate Dean and Associate Professor of Accounting and Experimental Economics. Before leaving the floor to them to cover today's topic, I would like to seize the opportunity to express my sincere and genuine thanks and gratitude to them for accepting to share their time and knowledge with us in this webinar today. So thank you again for everyone. Welcome everyone. And now I leave the floor to them to start the presentation.
Okay, well, thank you for that very nice introduction, and good to see you're looking very healthy. So that's very good.
Thank you.
Okay, well, welcome everyone to this section on diversification and risk management. And diversification is one of the investing techniques, and so we'll also talk about diversification and wealth management. I think those three things all go hand in hand, and anyone investing in the market is interested in wealth management. So that's kind of the broad topic. Today's session, the three sub-themes here. First is to start about why do we even care about diversification, and that's the first part that we'll cover. The second sub-theme is how do we actually form diversified portfolios, and then the third sub-theme will be your next steps for managing wealth via diversification. Let me stress that I'm not going to give recommendations today. We're teaching, this is from a teaching concept perspective. So your next steps for managing wealth via diversification via the concepts. And let me also stress today that I'm expressing personal opinions, and my institution, Carnegie Mellon University of Qatar, may not agree with all of my personal opinions, so they are personal opinions. So I am representing the institution, but expressing personal opinions. And Professor Farooqi may not even agree with some of my personal opinions, so that's fine. I mean, disagreement is fine, leads to good discussion. So hopefully, we'll have time for discussion of questions at the end. If there are any major burning questions, feel free, but we'll try and sort of get through the material and then leave time for discussion at the end with the material. Now, just to give you the bigger picture, there are many ways of approaching sort of investing in the stock market. And some common methods are to apply technical analysis. Another approach is fundamental analysis and relative valuation and valuation type of approach. A third emphasis is modern portfolio with diversification. And a fourth one is combining some of these earlier ones in smart beta. So basically today is about this third column here, modern portfolio theory and diversification. Now let me stress that diversification and modern portfolio theory, or portfolio theory in general, is a very tried and proven approach to investing. Sometimes it may not look the most exciting, but it has a very strong track record. And so, the principles today are very important to sort of serious investors. But we can discuss some of this at the end in terms of people's different risk attitudes towards investing. So diversification, risk and expected return. What's it all about? Well, investing is all about managing risk and expected return. And you've probably heard of the old saying, don't put all of your eggs in the one basket. I've quoted that many times, but I decided to look up who is this attributed to, and I hadn't realized before, but it's attributed to the famous Spanish author Miguel Cervantes, who wrote Don Quixote in 1605. But it applies in general to life, to many aspects of life, but it really applies also when you're managing risk associated with invested wealth. So it's a most important principle. Just don't put all your eggs in the one basket. So your eggs in this case is your money that you're allocating, your wealth that you're allocating to the market. But investing is all about managing both risk and return. And so that old saying goes a long way, but it's pretty silent about expected return. So basically, we're going to look at risk and we're going to look at expected return and understand what's meant by risk and expected return. So let me kick you all off with a question. The nice thing about sort of being online and not being face-to-face, it's very easy to ask questions, and this is all anonymous, so and there's no correct answer to this question. But the question is suppose you have to choose between the following two investment opportunities. Investment A provides a sure payoff of 125,000 Qatar riyals. Investment B is a risky investment. It provides a payoff of 250,000 riyals with a 50% chance and 62,500 riyals with a 50% chance. So in other words, you can take 125,000 for sure, or you can take the investment risky opportunity of doubling that, getting 250,000 Qatar riyals, but you have a 50% chance of earning half of that, 62,500 riyals. Okay, so we'll turn this over to the question on the screen, and if, as I say, there are no incorrect answers to this question, so you have three choices. Choose, I prefer investment A, B is I prefer investment B, or the third choice is I'm indifferent. Flip a coin and you give me just one of them. I'm not going to make the decision. I'll take either one. So
John, just a clarification for the audience. You will see multiple questions popping up. Just answer question number 1 for now. Don't worry about 2, 3 because they pertain to different content. But just answer question 1 for now. Thank you.
Yeah, just question 1. Yeah, we haven't got on to question 2 at all. And no right or wrong. This is just getting your interaction.
So we relaunched the poll. So if you had already put in a preference earlier, do it again, please. Thank you.
Thanks.
Again, only 13 people have answered so far.
Only 13.
Yeah,
Don't be shy. There's no right or wrong answers on this. So do not be shy on this question. It's absolutely.
And only question 1.
Yeah, you're not revealing anything on this. Do we have more answers coming in? We've got 101 participants. Just give an answer. I mean.
Okay. Okay, so I see. John, it seems they're unable to submit unless they answer all the questions. So just put in a dummy answer to questions 2 onwards. Just write A for all of them.
Put in dummy answers to the other questions. Yeah.
Yeah, sorry about that.
Yeah, sorry about that. Zoom is not perfect.
So what do you think of having the questions answered at the end? If
there's a sequence to it.
Well, it's just that I draw upon the answers to go into the next slide. So
okay.
Yeah. So just put in dummy answers to the subsequent questions, and then you can change those answers for this.
Roughly halfway, yes.
So we got half in, do we?
Yeah, roughly.
This is like a little mini market, actually. We'll see. Well, the next question is like a little mini market, actually, but yeah.
So some people are commenting that, John, your slide deck isn't clear, and that black box is basically the poll. So the way it works on Zoom is if something shows up on the screen, it takes over the screen. Okay. So yeah, so the poll is hiding something.
Yeah, sorry. Yeah, I see. Yeah, so I've moved it off the slide deck. So investment A provides a sure payoff of 125,000 reals. Investment B has a 50-50 payoff of either 250,000, that's double the 125 with 50% chance, or half of the 125 with 50% chance, 62,500.
I think we've reached a stable point now. So,
okay.
So John, it's around 44% said investment A, 47% prefer investment B, and 8% are going with flip a coin.
Okay, interesting. That's interesting response. Okay, so what does this question reveal? As I said, there are no correct answers to this question. It reveals what your tolerance for risk is. And so everyone, it's just human nature to have different attitudes towards risk. And by your answer on that previous question, given that I am interested in experimental finance and such, we can classify humans into 3 broad types. Risk averse, that's if you select one. A risk-averse individual requires compensation for assuming risk. Risk-loving, if you select 2, and risk-neutral, if you select 3. And so basically, people's risk preferences can actually change depending upon the situation, depending upon sort of the opportunities provided. So, for example, that little cartoon figure says, I'm a risk lover outdoors, but I'm risk averse when it comes to investing. So you've come out with 47% coming out as risk loving, 44% tend to be risk averse, and 8% are risk neutral with your answers to this. Now, it's also commonly observed that your answer, if I had changed those numbers to say 125 million Qatar riyals versus 250 million, with a 50% chance versus 62,500,000 with a 50% chance. That may have increased, I didn't ask this question, but that may have increased the percentage of risk averseness, because what we find with human beings is that as the money gets bigger, a lot of human beings tend to become more risk averse. So they tend to be risk loving in sort of for lower amounts, risk averse for higher amounts. Also, there's an age category here. So if you're sort of all young and starting off in your careers, you're more likely to answer probably B, the risk loving answer, as opposed to A. So there's a whole lot of factors that have gone into determining risk preferences, and it's just really a behavioural phenomena. It's not something that is right or wrong, and most humans would exhibit different types of risk behaviour in different situations. So risk averse in the market, when we talk about the marginal investor, we tend to assume the marginal investor is risk averse. And so, sorry about that, that's, the marginal investor is risk averse, only because the investment crowd, the marginal investor, the older investors tend to be more wealthy than younger investors, and so that's why we tend to observe this risk averseness comes through with markets. Now we'll build on what that tells, but so observe that in A you've got 156,250 Qatar riyals for sure, and in B you've got either double or half in A, you get 156, I've changed A to you. You get 156,250 riyals for sure. Now in B, you're going to get double or half that, with half 125 with probability 0.5. So another common measure in finance is a measure of risk associated with being the prospect that you can lose money, okay? So with investment opportunities, we don't actually just give you an investment opportunity. You actually have to pay for an investment opportunity. So now in this new question, we're changing investment A little so that it gives you a sure payout of 156,250 riyals, and with zero volatility. So you get that for sure. So there's no risk attached to it. Investment B, you get a you get a payout of 250,000 riyals with a 50% chance, and 62,500 riyals with a 50% chance. So investment B hasn't changed. So investment B, you can say, is much riskier than A, because investment B gives you a variable payout, whereas A just gives you 156,250 for sure. So now we're going to ask a pricing question. And again, there's no right or wrong answers to this. So your investment B has a 50-50 chance of paying 250,000 riyals or 62,500 riyals. I'm going to ask you, I'm going to put this up for sale now. I'm going to sell this investment opportunity. And there's 5 alternatives here that you can choose. Well, who would pay 75,000 riyals or less? Now, this should be the most that you're prepared to pay. So obviously, we all like to get it for the lowest possible price. But this is now the most that you're prepared to pay. Would you bid up to 75? Would you bid up to 100,000 for this investment B? Would you bid up to 125,000 for investment B? would you bid up to 156,250 for investment B, or would you bid up to 165,000 or higher?
So now we're getting the answers in. Interesting.
This is what the financial markets do every day. They discover prices for risky investment opportunities.
So Faisal, you're asking how do we choose an option? Are you asking how do you actually input an option, or how do you think through it? So it seems that you have to answer all the questions and then press then submit. So there's multiple questions here. This is question number 2 that we're solving right now. Samir, there's a question. They're asking if the recorded session would be available.
Yes, we are working on that. So yes, and we will announce it, inshallah, after editing the video. We'll announce it on our website so that everyone can watch it, inshallah, on the YouTube channel of QSE.
Thank you. So John, I think we've got around 60% of the panelists of the audience has voted.
Okay, good. So what are the results?
40% will go with the first option.
Yeah.
21% will go with the second one. 15% said 125,000.
Okay.
21% said 156,250, and 3% are willing to pay more than 165,000.
Okay, good, good. Okay, so interesting. So again, this is what markets are all about, is price discovery. And once you discover a price, we can talk about an expected return. Now, for this particular example, I'll let you work out for other cases, but suppose the market settled on 125,000. So we had 15% actually. Most of you want to drive a hard bargain, I can see. So you want to get this as low a price as you can. But suppose the market did settle on 125,000. Now we can work out an expected return. So the risky opportunity gives you a 50% chance at 250,000 and a 50% chance of 62,500. And if we divide that by if we divide that by 125,000, we're going to get a return of 25%. Okay, because our expected return is 156,250, and the expected value of this is 156,250. So if you can buy it for 125,000, you are getting an expected return of 25%. Now, if we went back and worked out these others, you could see that if you were managing to get it at 75,000, your expected return is really, really high. At 100,000, you've got a pretty good expected return, much higher than 25%. At 156,250, your expected return is 0. And at 165,000 or higher, your expected return is negative. But consistency with being a risk lover, you're quite happy to accept a negative expected return. It doesn't mean that you're losing money for sure. You're just getting a negative expected return. But mostly in the financial markets, we observe that risk is priced in the market and people get a positive expected return for acquiring risk. So the expected return, if you paid 125,000 on this, is 25%, which is a decent return, but it's still a very risky investment. You've got a high expected return, but you could also lose some money on this investment. So every day, this is what financial markets are all about. They discover prices, and every time those prices change, your expected return is changing. So this makes the investment decision a sort of a difficult decision. It's a very dynamic environment because each day, in fact, each minute, each few minutes, the prices change. Every time prices change, expected returns change. So this is a dynamic problem where we have risk and return. So what we tend to look then to try to handle this problem, we look at the history of returns over time. And from looking at the history of returns over time, we can measure things like the average return and the volatility of returns. So we like positive returns. Everyone likes positive returns. Positive returns are good and we are building wealth. We all like to build wealth. Negative returns are not good because we are losing wealth if they're realized. So considering opportunity B, if the negative outcome is realized and you've paid 125,000 reals for it, even though your expected return is 25%, your realized return is suddenly negative because the bad outcome happened. So welcome to the world of investing. We all have to deal with the possibility of bad outcomes that are going to destroy wealth. And so this is the risk side of the problem. So you can see that risk and return are intimately related here, okay? Once we discover prices, over time, we can measure risk, and over time, we can measure what the average return is. And so they're the two key inputs into our investment problem. Now, with these results over time, we get some positive stuff can happen. So if we return back to opportunity A that gave us a sure payoff, and if we bought opportunity A for 148,809 reals, then our return from opportunity A is 5%. So this is like investing in sort of a government bond. The government bond is pretty close to being a sure return. Once we invest in a bond, we know basically what return we're going to get over time, and that's for sure. Investment B is like investing in a stock. Investing in a stock, we don't know what the return's going to be over time. Nothing's promised to us by the management. They're working hard, they're trying to create value, but we can only talk about an expected return. So these two situations vary over time. If we compound sure returns over time, they steadily grow on us. So if we're investing in opportunity A and we paid 148,000, so we have a sure return of 5%, our investment will take 11 years to grow to just over 250,000. Recall that opportunity B may give us 250,000 in one shot. So this is your classic problem facing all investors. And this is where your risk preferences start to play. If you want to be very risk averse, and the risk averse conservative investor likes to see just steady growth over time. A more aggressive risk loving investor likes to try to chase sort of a higher return, but they're going to have to assume higher risk. Now with youth, you tend to want to chase higher returns. With the accumulation of wealth and age, you tend to sort of shift more into, or we observe that humans tend to shift more into more conservative and looking at lower risk but steady rate of return. So this is the classic risk return problem. But let me draw a warning to the younger investors out there that do want to chase a higher expected return. And believe you me, I was a young investor once, and so I can relate to this. To chase that higher return, you have to assume a lot of risk. And if you assume a lot of risk, bad things can happen. And we talk about drawdown, a minus 100% drawdown. So in Excel, you can simulate opportunity B 100 times and see, well, what would have happened if I had repeated this investment 100 times? Well, what tends to happen, and you get different paths each time you simulate it, but what tends to happen, you'll observe, is that some part in time, you'll be looking pretty good. You'll be looking like a champion, that the odds are that suddenly your wealth will really increase. But what always happens is that beyond a certain point in time, you lose it all, minus 100% drawdown. And so this is what happens if you get too aggressive with chasing high expected return and assuming a large amount of risk, because you only have to face a little bad run of outcomes, and this goes down to zero, basically, which is a minus 100% drawdown. Now, this happens to a lot of traders in the market, and it's human nature to want to sort of chase high returns. But this is the problem. Now, in 2008, there was a major financial crisis that you all are aware of. And a number of banks in those major financial crises running up to 2008 were looking stellar performances. But then suddenly they fall over the cliff and they face that minus 100% drawdown. So the risk management side of investing is critical. And it doesn't matter if you're the long-term investor or if you're the day trader or what. Your biggest enemy here is minus 100% drawdown. And this happened to Bear Stearns in the USA. It happened to Northern Rock, the bank in UK. And it happened to other banks as well that had to be all bailed out because they took on too much risk, trying to chase higher and higher expected returns. The market even rewarded them, kept rewarding them for years as they were running it up. But then suddenly you hit that cliff. So the risk management side of investing, I cannot stress more solidly the importance of that side of investing. So now let's see how we deal with the risk management side of investing. And so we're going to come back to this most important concept of diversification. And we had in our original questions two investment opportunities, A and B. A was like the turtle, slow and steady, 5% expected return, but riskless. B is like the hare and the tortoise, the tortoise and the hare. Fast track, 25%, lots of risk, but volatility was large. Our goal is to build wealth, okay? And whether you're young or old, you've got the same goal. You want to build wealth. Is there a way of getting the best of both worlds? Because 5% steady return fine, that's good. 25% is attractive. That's an attractive expected return. Those of you who bid lower, that's an even more attractive expected return. So question is, how can you get the best of both worlds without losing your wealth, without being that picture at the top where you've faced suddenly minus 100% drawdown? Well, the answer to this question is yes, you can. But recall how we started. You don't put all of your eggs into the one basket. So in this simple example, I'm going to consider the power of diversification with just two securities here. If we put all of our eggs into the one basket with B, we know eventually we're going to hit minus 100% drawdown. That's game over. You're out of the market. But now consider diversifying 50-50. 50% of your money you allocate to A, 50% of your money you allocate to B, and you keep those ratios at 50-50. So that means if you take some payoff from A, if you lose money in B, you've got to now sort of borrow from A and make up that to the 50-50 again. So you're always maintaining 50-50 over time. It's actually a very dynamic investment strategy. But look at what happens. The left-hand side was 100% in B. It hits minus 100% drawdown, or you lose it all. The right-hand side, and you can simulate this in Excel, actually, this dynamic strategy takes off. And it does actually avoid the minus 100% drawdown. Now, it's beyond today to talk about the reasons for that, but it's called volatility pumping. If you have a very volatile opportunity that gives you a high expected return, then and it's independent, there's a few things there that are going on, but this 50-50 dynamic strategy will avoid, or mathematically should avoid, a minus 100% drawdown. So this is just a very simple example of what we mean by diversification. But let's take a closer look. Let's put this under the microscope now, and let's see what we really mean by diversification. But there are sort of good strategies and there are bad strategies when you ignore risk management. So the right-hand side is not ignoring risk management. It's a good strategy. The left-hand side is ignoring risk management, and it's a bad strategy. So managing risk and return and having good approach to risk management is going to guarantee you, well, not guarantee you, we don't guarantee anything in the world of finance, but it's going to make it more likely that you'll increase your wealth as opposed to reducing your wealth.
John,
Okay.
There's a question.
Yeah.
Before you move on. There's a question someone's asking, can you elaborate a little more on the 100% drawdown? So the fact that B gets wiped out, the sequence of negative returns.
Yes, minus 100% drawdown means that you lose all your money. So let me give the example on this left-hand side. So you're going to get double or half each time. So you either get 250,000 or you get 62,500. Now, suppose you hit that bad outcome. So now your wealth has gone from 125,000 down to 62,500. Now, you can get double or half. If you get two bad outcomes in a row, now you're down to 31,250. If you get double, you're back to 62,500. Now, let's consider we get three bad outcomes in a row. Now we drop down to 31,250. Then we drop down to about 15,500. Then we drop down to 7,500. So basically, if you invest all your money into that one opportunity and it's highly risky, you just need a few bad draws and your wealth starts declining. Now, on the other side of the fence, if you get a few good draws, you start zooming up in wealth. But if you let that run over time, you're going to sometimes statistically hit a bad run of low outcomes. And that just quickly wipes out your wealth, because each time you're losing 50%, 50%, 50%. And so that's why this little chart, it started off high, you got a few good payouts, and then now you started down and it starts crashing down. And then once you get to really small amounts, it's almost game over. I mean, if you got $10 and you've doubled it, you get 20. If you halve it, you're back to 10. If you halve it again, you're back to $2.50. 2.5 reals. If you halve that again, you're down to 1.25 reals. Then so that's what I mean by the 100% drawdown. And that's, so the way that the risk management answer to that problem is, you don't put all your eggs into the one basket. You never allocate you never have all of your wealth at risk in the one opportunity. That's playing with fire. So in the second one, we've split our wealth. So we're 50-50 kind of thing. And so now we're basically always maintaining 50-50. So when we get these positive payouts, we end up buying more of investment A. And so we're building up the proportion of investment A, which is giving us this solid return, and it's being funded by investment B. So it's a very dynamic strategy that it may not be the optimal strategy, I'm not saying that, but it's a strategy that is going to avoid, statistically at least, this minus 100% drawdown. So never, first lesson today, currently, don't ever put all of your eggs in the one risky basket. If you're extremely risk averse, and I'm not recommending anything today because it depends on your preferences. If you're extremely risk averse, you may put all your eggs into a government bond, okay? But you're going to earn a very low, slow and steady sort of return. The nice thing about the stock market is going to give you higher expected returns than government bonds. And so really it's diversification that matters. And it doesn't matter whether you're old or young and aggressive. If you're older and conservative or young and aggressive, diversification matters to both of those groups. Most important.
John, we have another question, which I think is a good segue into the next part. Someone's asked, while diversifying, how can we maintain our capital without losing at the same time? How will compounding work? So in terms of diversification. So,
well, we can never, if you're in risky investments, we can never guarantee that you're not going to lose some, but you're maintaining a proportion of your capital, okay? So it's the proportions that you're maintaining. It may start to go down and then sort of build up again. So that's and the compounding over time. Yeah, the power of compounding really kicks in if you're the long-term patient investor. My recommendation to everyone is to be the long-term patient investor. So you're serious, even if you're young and just starting out in your career, your serious sort of retirement fund money should just go into long-term patient investing style, buy and hold, and you just keep accumulating, because then you do build up the power of compounding. And this is, I mean, the Warren Buffetts of the world, basically they are long-term. Warren Buffett always takes at least a 10-year investment horizon. So being long-term patient investor, you get compounding on your side, not against you. So yeah, but again, youth brings impatience with investing, and impatience with investing, if you ignore risk management, you're going to face that left-hand side of minus 100% drawdown. So that's be careful. Okay, well, what's going on here? Well, firstly, in the example I've given to date, all risk was unsystematic, because basically investment B was completely independent of investment A. So what investment A did had no bearing on investment B, or vice versa. And so we talk about, if all risk is unsystematic, if we had a whole bunch of opportunities, so suppose all of the stocks were completely independent of each other, okay? So we have 1 stock, 2 stock, 3 stock, 4 stock. As we're going down this thing, we can eliminate freely all of the risk. So this is like perfect diversification, if you like. So that all of that risk, if we just combine a whole lot of investment opportunities that are all independent of each other, if we take at least 16 of them, we've pretty much eliminated all risk. 16 and beyond, it could even be more. So this is one way of approaching risk management, but it depends upon all risk being what we refer to as unsystematic. So the risk of one security is totally unrelated to the risk of another security. You might say, well, that's not quite right, is it? But let's come back to that in a second. If the risk of all of our securities were totally unrelated to each other, diversification would rule supreme, because we would just form a large enough portfolio, we would get all of this expected return with no risk. So in other words, we're able to mimic that riskless opportunity A, if they were all unrelated to each other. Now, to be unsystematic, we refer to this as being firm-specific type of events. So, and there's a lot of firm-specific events every day reported in the financial press. And in fact, on July 24th, 2018, Facebook, which you're aware of and probably use, reported on Wednesday that growth, this is 2 years ago, this is in 2018, reported that growth in the digital advertising sales and in the number of its users had decelerated, in fact, increasing at a decreasing rate, in the second quarter. The company's leaders, including Chief Executive Mark Zuckerberg, added that the trajectory was not likely to improve anytime soon, especially as Facebook speeds to improve privacy and security of users. So in other words, their growth is slowing down, basically, they announced. And they further announced that this is likely not to improve anytime soon. So Facebook has grappled with months of scrutiny over the Russian misuse of the platform in 2006 at the American presidential campaign, and the harvesting of users' data through political consulting firm Cambridge Analytica. That was that firm in the UK. So all this news came out about Facebook on the one day, July 24th, 2018. So let's throw you into question 3. How do you think the market responded to this particular news item? Was the price just a little lower? Did the price drop significantly, or did the price increase a little?
So while you're answering this question, just a note, there is a Q&A option. So if you have any questions, please send them over there, and we will be taking questions at the end, just to go with the flow, have a better flow of this presentation. We'll take questions at the end. Thank you.
So when we have a reasonable sort of consensus, we'll move on with this.
We have around 50% of the people have voted, John.
Okay, that should give us a
I'm
consensus.
not going to change by a whole lot.
Okay.
So price was a little lower, was 22%.
20,
Price
okay.
dropped significantly is around, well, it's changing a little, around 73%.
73.
And price increased a little is 4. So these numbers won't add up because 1 or 2% it's moving a little.
Yeah.
But I think it's pretty
That's
clear.
okay. Consensus is the market has voted that price dropped significantly is the majority here in the market. So if you're all trading in this market, the price would drop significantly. If we look at the actual results, bang, yeah. B was the market reaction that the Facebook price is that green little chart, and where the arrow is there is on that exact date, and you can see that Facebook immediately dropped overnight. It announced that news, closed the market, and the opening price the next day way down, way down. But notice what's happened to the rest of the general market. The general market, and that's the blue line, is sort of the broad market index. The broad market index actually moved up. So this is a classic example of firm-specific news, and this is a classic example of what we refer to as unsystematic risk. That if you had just had all your eggs in Facebook, you faced a massive loss or a significant loss overnight on that one investment. But if you had a more broadly diversified portfolio, you could shrug it off, okay? Because all your eggs aren't in the one basket. So this is firm specific. And again, you want to avoid sort of putting all of your eggs into the one basket here, because what you are carrying is unnecessary, unsystematic risk. So forming a portfolio is a great way of spreading the risks and generating consistent returns over time, which is our goal, to build wealth. And even if some adverse event that can be highly significant, I mean, the market really did respond to that Facebook one. Sometimes the market surprises you, but generally it's quite predictable, the response to a news event like that. So if some adverse event hits the entire, let's consider the next problem. So if you can spread the risk, unsystematic events like that, you can shrug them off with a diversified portfolio. But now consider a second type of risk. If some adverse event hits the entire economy, then the financial markets fall as a whole. So if we go back to that previous slide, you can see that the blue one can go up and down as well. And so it can fall. So the entire market's falling at times, but individual stocks, if they're hit by the unsystematic risk news event, then they can move in a different direction. Okay, so what happens if the adverse event or the adverse news item hits the entire market? Well, now we observe that the majority of stocks fall. It may not be all, but the majority of stocks fall. And we refer to this as correlation, that returns start to move together. And in terms of risk, we refer to this as systematic risk. So systematic risk is something that affects the entire economy, the entire market. Unsystematic risk is something that affects only a particular stock or maybe a couple of stocks, okay? So the previous diversification slide I put up doesn't tell you the whole story, because correlation matters. We have to take into account that there are these different sources of risk. One is unsystematic and one is systematic. And the higher the degree of correlation, the less positive impact diversification has. So in other words, the enemy of diversification is correlation or systematic risk. So let's see how this works for the market as a whole. Well, we know that in 2008, there was a financial crisis. And you can see that when that financial crisis hit, the entire market fell significantly. In fact, globally, all markets fell in that financial crisis. So it didn't matter whether you had good stocks, bad stocks or what, or whether you had a widely diversified portfolio or not, your portfolio suffered from a loss, an unrealized loss. We saw this again today, not today, sorry. We saw this again this year with the pandemic crisis. The entire market sort of fell. You can also see that markets tend to recover over time. As the economy starts mending, markets tend to recover. So this picture tells you that you have to worry about systematic risk, events that affect the entire market, but you don't have to panic with the systematic risk. But let's look at this now from diversification perspective, okay? The previous slide demonstrates that when a crisis hits the market, it impacts most stocks, if not all stocks. So technically, correlation increases because all stocks now tend to move together in the same direction. And so now diversification suffers a little bit. So we have this dual nature of risk that we have to worry about. One type of risk is risk that we can handle nicely. That's unsystematic or firm-specific risk. The second type of risk we can't handle nicely. We're kind of stuck with it. And that's called systematic risk. And that arises because correlations of returns tend to move together. They start falling together. Okay, so the recent event of the coronavirus was a source of systematic risk, how the coronavirus tanked the markets. And so it actually had a major impact initially on the markets. And then as things started sort of unfolding, events unfolding, the markets are recovering at the moment. Some would say they've recovered too quickly, but they've been recovering. But coronavirus and the crisis of 2008 and in Qatar, the embargo, they're all events that we would refer to as economy-wide impact systematic risk, okay? So now the true picture for diversification looks as follows, and you'll understand it better by the picture. The previous one, I had only unsystematic risk and we could freely get rid of all risk. But this one now, we have both systematic and unsystematic risk. So if you diversify naively and just throw in 1 security, 2 security, 3 security, 4, you get down to about 16 securities and you're getting pretty close to this line, okay? So you can freely diversify away unsystematic risk with about 16 to 20 securities, but you're still stuck with, your portfolio is not risk-free. It is still stuck with systematic risk. And so that's as far as diversification can take you. It can only bring you down to, or naive diversification can only bring you down to that sort of level where we've freely got rid of everything except for our systematic sources of risk. So the lesson here is that systematic risk cannot be freely diversified away. It affects the whole market. It's not diversifiable, so diversification is not going to help you. So therefore, the market will compensate you. Recall at the beginning, I said that on average, if financial markets are risk averse, if our mythical marginal trader is risk averse, that determines the price at the margin, then they're going to be compensated for assuming systematic risk. But non-systematic risk, which can create a minus 100% drawdown if you put all your eggs in the one basket, you're not getting compensated for. So non-systematic risk is firm or industry-specific risk. It's diversifiable freely by forming a diversified portfolio, and therefore the financial markets aren't going to really compensate you. So in other words, you're not getting as much return as you should be for assuming that much risk. So this is the first lesson here, that systematic risk you get compensated for because you cannot freely diversify it away. Okay. Unsystematic risk, because you can just freely diversify it away, you don't get compensated for. So naive diversification manages unsystematic risk very efficiently. But let's go beyond naive diversification. The question is, can we do better than just here? And I'm answering this in theory. In theory, the answer is yes, we can do better, okay? Now, sorry, I skipped over one slide, and this is an important slide. So let me just hold that thought for a second and just illustrate how this table, you get compensated for systematic risk. If we look at the long-term performance of the US markets, this is over 100 years, so we're looking over the long run here. What do we see? Well, we see that small stocks are the riskiest of the whole lot. They've got a 40% annualized volatility. That's pretty high. Large stocks have a 20% annualized volatility. Long-term government bonds only have an 8% annualized volatility, and Treasury bills only have a 3.3% annualized volatility. But if we look at the CAGR is the compound annual growth rate. So in other words, if you invest 100 reals on day one, after N years, it grows to say 1,000 reals, then we can determine how much your position has grown by. So on average, your growth rate for large stocks is 12.5%. For small stocks is 19%. For government bonds, 5.3%. Treasury bills, 3.8%. You can see that over the long run, if you're compounding at the bond or at the bills rate, your portfolio is only going to grow pretty slowly. If you're compounding at the long-term government bond rate, it's going to grow faster than the Treasury bills portfolio, but it's still going to be fairly slow. If you're prepared to take on a lot of risk and you grow it at the small stock rate, you're growing on average 19%, and large stocks 12.5%. So you can see here that the market, this is what we mean by the market compensates you for assuming systematic risk, because this is a large portfolio of large stocks. This is a large portfolio of small stocks. So we have got rid of all of the non-systematic risk or unsystematic risk, and what this volatility is purely the systematic risk. So the rule in the marketplace, on average, over the long run, is a positive relationship between risk and return. And that's consistent with a risk-averse average investor in the marketplace. So that the risk-averse investor has to be rewarded for assuming risk. And this is a reasonably a straight line, actually, between risk and return in this marketplace. Okay, so that's sort of the importance of diversification. You can get rid of one source of risk and you'll be compensated in the financial markets for the remaining risk. And that's an important lesson to learn, that it's far better. There are rational ways of chasing higher returns and there are irrational ways of chasing higher returns. And you're much better chasing a higher return in a diversified portfolio than you are by putting all your eggs into the one basket. Okay, now the markets are all globally connected, and if we plot out 20 years of the Qatar stock market, you can see it goes up and down in response to the major sort of events that hit the market. But on average, over that 20 years, it's actually growing. So a Warren Buffett in the Qatar stock market would be doing very well, actually, because over the 20 years, there's been growth. Even though from a year-to-year basis, there can be a lot of fluctuations. Okay. So now the question I asked before was, can we do better than naive diversification? Okay. So can we eat into this level of systematic risk? Can we lower the bar, in other words? Can we get our sort of our red line, our portfolio to break through this bar and fall below it? That's the question. And this was the question that has attracted sort of a lot of theoretical research. Going back to the father of this research was Harry Markowitz in the 1950s, okay? And what he observed is that with naive diversification, it's fine. It's the equivalent of don't put all your eggs in the one basket, but it does ignore one thing. It ignores expected return, okay? And so it may not be that just equally weighting every stock in your portfolio is the best way of managing both risk and expected return. So his objective was to bring optimization tools to bear to the problem for managing both risk and return. And basically, the bottom line of this is going to be, he's going to allow for unequal weighting. Now, this makes intuitive sense if you think about it. If you've got, say, 16 to 20 stocks in your portfolio, some of those stocks you may assess to be better than other stocks in terms of the return front. They may all be good at reducing your unsystematic risk, but some may be better on the return front. So you may want to change your tilts a little from all being equal weights. Equal weights just mean that you break up your wealth, divide by 1/16 and put an equal amount into each stock. That's equal weights. But unequal weights means that, okay, instead of doing 1/20th of my wealth in each stock, I may make 1/10th of my wealth in stock A and only sort of 1/40th of my wealth in stock B. So I'm changing those weights around because I'm still managing my unsystematic risk, but I'm changing those weights around to manage my expected return. If I think stock A is going to give me a higher expected return than stock B. So that's the idea behind Markowitz, intuitively. So let me ask another question here, okay? Which investment project do you prefer, Project B or Project E? We're plotting both of these projects in a risk-return space. So on the y-axis here is expected return, and on the x-axis is risk or volatility of return, okay? So this is expected return, this is volatility of return. So which investment project do you prefer? If you could only invest in one. So when we have a reasonable consensus, let me know.
John, I think we're at a point where
okay, yeah,
definitely one way. So 88% of the people prefer Project B, 12% okay. Project E.
Okay, 88% B and 12-odd%.
90%, yeah, roughly.
Yeah, roughly 90%, 10%. So yeah. Project E is attractive to risk lovers, especially if you're really risk loving, because it's got a lot more risk. Project B is attractive to risk averse. So So Markowitz actually is going to make the assumption that investors are risk averse, basically. And in that previous slide, we say that investment B dominates E if either of the following happen, okay? If it provides an expected return that's higher without higher risk, or it provides a lower risk without lower expected return. So what do we mean by that? This one provides a higher expected return and it's of lower risk, because if we drop down to this x-axis, our risk level is there, whereas this risk level is out here. So we get a higher expected return without assuming any more risk. Or we can get basically minimal risk at a certain target return. So both of those are equivalent statements, and we can verify that both those conditions exist. So this is called B to risk-averse investors, and I'm stressing to risk-averse investors, B dominates E because it satisfies that. So turns out you can refine an investment opportunity set for risk-averse investors, and you can identify the subset of projects that do not get dominated. Well, we can see that B dominates A, B dominates E, so A and E are knocked out, but B does not dominate D because D gives you higher return with higher risk. And B does not dominate C because C gives lower risk but a lower return. So we can refine the opportunity set to just 3 here. We can knock out A and B. If we can only invest in a whole project, we can knock out A and E, sorry. We can knock out A and E because they're dominated by C, B, and D. But which one of C, B, and D that we choose depends upon how risk averse or how little risk averse we are. If we're really, really risk averse, we'll choose C, which is probably government bond type of thing. If we're less risk averse, we'll choose D because we're ready to assume more risk for assuming more return. And if we're in between, we'll choose B, okay? But we'll never choose A and E if we're risk averse because they're both dominated by B and D here. Now, if we're really risk loving, we may just go for E because it's got a high level of risk. So it's going to give us, in some states of the world, it's going to give us a very high payoff, but we're assuming a lot of risk. So this is where the risk preferences, this is where your initial question we asked you, your risk preferences matter when you're making investment decisions. But our standard assumption in finance is to assume that the marginal investor, on average, we don't say the entire trading crowd, but the marginal investor, the on average one that determines that market clearing price is risk averse. So we can drop this to 3 securities now, 3 projects. But the financial markets, the stock exchange, the Qatar Stock Exchange, give us even better set of opportunities because they allow us to trade shares in all of these projects. And if we can trade shares in all of these projects, we can even do better. And so this was the idea behind sort of the market widths, that financial markets make all investors better off because you can now trade shares, and that allows you to get even better risk return opportunities if you are prepared to sort of go through the quantitative work that Markowitz went through. So I'm going to illustrate this for a sample of stocks, and these stocks are no way I'm not sort of recommending these stocks in any way, and I'm not recommending these stocks in any way. I've just sort of pulled a set of stocks because we're not about recommendations today. But we want to know first what Markowitz is going to work on. He's going to work on the fact that the stock returns are related. They're not independent of each other. They do move together. So if one stock's affected by an event, other stocks will be affected to a greater or lesser degree by the same event. And so therefore we have correlations. And so the first thing I've plotted there, just to illustrate that none of these, if they were truly independent, the correlations would be zero. And you don't see zero in, or you don't, virtually don't see zero in any of these cells. So all of these stocks that I've chosen are correlated to some degree. And that means that none of these stocks, there's going to be systematic risk when we're working with these stocks, as there always will be. It wouldn't matter what set of stocks I chose, there's always systematic risk. But what Markowitz is going to do is he came up with a clever optimization algorithm that solved for the efficient set of stocks. Now, the efficient set of stocks is at every one of these points, I have maximized my expected return for a given level of risk. Or you could think about it as minimizing your risk for a given level of target return, same way. And so when you plot all the scatter plots of the stocks, they're going to sort of fall in a scatter plot here. Some are going to look better than others, and but just because you're down here and dominated, when you're allowed to trade shares, then all of these stocks may end up in the optimal Markowitz portfolio, because there's always this trade-off between return with risk and with the way that they are correlated, the way that they move together. So those three dimensions, which is very hard to plot here, are all taken into account with Markowitz. And so it comes out as this nice little line, and all the individual stocks lie below this line, okay? It's a nice little bullet-shaped curve. Or everything else lies below it. You can't get above it. You would like to get above it. You'd like to sort of get a higher return for a lower risk, but the markets just don't give you that opportunity. So what the markets are giving you the opportunity of is to form a portfolio that moves along this curve. That's what Markowitz solves for. So if I take any point on this curve, it corresponds to a portfolio. And so if I just take this point randomly, this was giving an expected return of 21%, and these were the weights that were giving that particular portfolio. Now, since Markowitz, there's been sort of a generalization of his approach so that you can throw in additional constraints. You can say that I do not want any stock to be greater than, say, 20%. And I do not want any individual stock to be less than, say, 3% or 4%. So, and the nice thing about Excel today, unlike in Markowitz's day, Excel gives you the tools for doing this, actually. It's in the hands of pretty much every investor if they want to become acquainted with the appropriate concepts. So this, every point here is a very efficient, for just this set of stocks and just this sort of history that I gave it, is an efficient portfolio that cannot be dominated by any other portfolio if we're chasing this particular target return or this particular target risk. And so what Markowitz has done he's moved the naive diversification down below, because the naively diversified portfolio lies below this orange line, but it doesn't lie all that far below. So my next slide here says, what are the next steps for investing? And different ones of you will be in different stages of your life and different stages of investing. So naive diversification, which doesn't really require any fancy algorithm or any fancy sort of optimization tools, and just puts an equal proportion of wealth in each stock, is a great way of starting off investing, or at least for more conservative investors, actually. And I can tell you a true story that my parents were not savvy about the stock market. And in fact, they were very sort of risk averse about putting wealth into the stock market. I talked them into putting money into the stock market when I was, I got interested in the stock market in the end of high school and at college. So I talked them into getting involved with the stock market, but for them and their risk profile, we just did a naively diversified portfolio, 20 stocks. Actually, that was it. They did incredibly well out of that 20 stocks, okay? So they did thank me later, even though they were really cautious at the time. But so naive diversification works if you hold it over the long run. Now, I was kind of younger and more aggressive, so I had to learn risk management myself. Even though I was giving advice to my parents, well, they put me under strict controls for their money. They didn't want any of my fancy sort of risky strategies or anything like that. So I had to learn, and I had. When I was younger, I did learn about minus 100% drawdown. And a bunch of you will eventually learn that because you get greedy. You get greedy and you chase sort of the thing. But a good starting point, and especially for long-term money accumulation, is naive diversification, because what that guarantees you, especially if you form it with about 16 to 20 stocks, that will guarantee that you're eliminating unsystematic risk. And you're at least coming down here with 16 to 20 stocks pretty close to the level of systematic risk. Now, to get below that, you'd have to get into sort of market diversification, and fund managers use a form of it. They'll throw in their own sort of additional constraints and tilts, and this will get them below that. But another way is actually, suppose there are dynamic variations to this, that you may want to rebalance periodically, and how frequently is up to yourself, so that you do maintain those equal weights. That is actually a volatility pumping naive diversification strategy that has theory in support of it. So that's a dynamic variation. But a question I know will probably come up is younger investors have a different risk tolerance. Well, the question is, do younger investors have a different risk tolerance compared to older investors? And I'd say yes, because younger investors are typically working with less money than the older investors. The older investors have more to protect on their wealth. So does this change the above? Well, let me sort of raise a flag of caution. And some of you will learn this the hard way, but luckily with smaller amounts of money, actually, than wiping out a large amount of money. But the drawdown math is you want to avoid this vicious investment cycle. And the vicious investment cycle is that if you lose a little, the gain to break even is more than what you've lost. So we start at 5%. The gain to break even now is 5.26%. Okay, so now what do you have to do? You've got to put in a slightly riskier investment. Now, things may work out fine, and then you suddenly lose 10%. Now the gain to break even is 11.1%. If we jump this to 20%, if you lose 20%, you've got to make up 25% to break even. If you lose 40%, now you've got to make up 66% to break even. 50%, now you've got to double your money before you can break even. So you get into this vicious investment cycle, down cycle here, that lose a little means that you've got to take on a little more risk, which puts you in the situation that you might lose a little more. Now you have to take on more risk, and then eventually you end up at minus 100% drawdown. That's what you want to avoid. So diversification is the best, and in fact the only method I'm aware of that would avoid this potential risk of minus 100% drawdown. So it doesn't really matter whether you are an aggressive investor, that means you're very more in the risk-loving sort of camp, or whether you're a very risk-averse investor, diversification is going to help you. And unless you're just an extremely risk lover, and then fine, okay, you're going to just enjoy risk. But that's not the majority. In fact, that would be an extreme minority that ever falls into that. Everyone else actually likes to manage risk, okay? So you can manage risk in a more or less aggressive manner, but it's always going to involve diversification. So the bottom line of today is to think portfolios. And when you're thinking portfolios, basically, you're going to think in terms of diversifying across sectors, because we'll see some sectors some days do better than other sectors on other days. You're going to diversify across stocks. You can throw all of that into your choice of your stocks in your portfolio. But if you just want to get off square one with no fancy math or anything, naive diversification is a very nice way of getting off square one. And naive diversification will give you, if you're the tortoise and you're prepared to just hold it over time, it usually rewards you. And there are no guarantees in finance, and all you can do is look at long-term averages. But over the long-term averages, the market will pay you for assuming that risk. So that's a good starting point, is naive diversification. So today, basically, we're in this third column, and I would say never deviate from diversification, frankly. So you always want to work with portfolios. And if you're younger and more aggressive, you can get more aggressive portfolios. If you're older and more conservative and you've got more money you're throwing at this, then yeah, you want to really worry about your risk management side. Okay, so let me sort of stop there, and let me throw it open to some general questions. Hopefully we've convinced you that diversification is good, and also that forming portfolios in the stock market is good.
So John, just one more note on diversification.
Yeah.
I also want to point out that there are biases, behavioral biases involved when we invest. And within portfolio, one of them is this mental accounting, where you may be having an investment in different companies and you won't look at them as a portfolio. Instead, you will put them into small buckets. You'll say, this is my risky portfolio, yeah, this is my safer portfolio. When in reality, what you're doing is you're creating one big portfolio.
Yes.
And maybe Samir, maybe you can have one day maybe a 1 hour session on some of these investing biases. Yeah. These are all mental biases that people get into. So using questionnaires and using examples, just demonstrate to people how we all fall into these traps. Just a suggestion.
Yes. Yeah, you raise a good point, because behavioral, the trading crowd in the financial markets is a human trading crowd. Okay. Even though if they're running algorithms, there's still a human programming them. So the trading crowd is human, and humans tend to have these behavioral biases. So and the one thing that I've noticed in the financial markets is that, and this is documented in research, is that there's an overreaction to good news and there's an overreaction to bad news. So in other words, what you'll find is that when the economy is booming, you'll tend to see all the financial press stories being very positive and very reinforcing. So it kind of gets the market sort of bidding up those prices higher and higher. But when there's a bad news event occurs, suddenly all the press stories come out as being bad, and investors panic and sell. So let me go back to, this is something to avoid if you can. This was 2008. Okay, it was doom and gloom. A massive drop in the market. It was one of the worst drops in the market. Doom and gloom here. But notice that if you sold there, and then you suddenly saw the market racing back up again and you buy here, your investment performance is going to be horrible. So I had many friends in 2008 phoning me. They weren't sort of finance friends, but saying, you know, we're going to sell everything. And I said, no. I said, don't. I said, just turn off the news, ignore it. In fact, Warren Buffett's advice is kind of neat. He does not, or he claims he does not have a stock monitor screen in his office because he doesn't care about what's happening in the market on a day-to-day basis. Now, truly he does, but basically he puts the faith in the fundamentals and his portfolio that he builds. I mean, even Warren Buffett has a portfolio of about 10 stocks. He doesn't go the whole 16, 20, but Berkshire Hathaway usually has about 10 or so, or more these days. So the first thing to avoid is to try and handcuff yourself. And the same feeling was in the pandemic too, the same thing. I was watching, you know, you're watching every day and your wealth is just declining. And you think, oh no, this is the end of the world, is it? No. But you have to just keep reminding yourself, don't overreact. Don't overreact. You may want to, maybe you shift into some lower volatility stuff. And I did a little bit of that myself. I did do some shifting, but I didn't get out of the market. And what happened after that initial drop in the pandemic, we see sort of recovery going on. And in about, you know, I'm the optimist, so, you know, they'll eventually come out with the antibodies and things like that. And so, you know, a few years down the road, it'll be forgotten about again. And the markets will be sort of all recovered. Like this 2008. I mean, if I'm teaching my undergraduates now, they say, what was 2008? I mean, it means nothing to them, even though it wasn't that long ago. It was 12 years ago. Now, admittedly, they're probably 6 years old at 2008. So I don't think you get many 6-year-olds investing in the market. So they weren't really worrying about 2008. But that's this overreaction to good news, overreaction to bad news, actually, is the one thing. So, you raise an excellent point that behavioral finance is most important. And you can sort of time your entry into your portfolios using those behavioral sort of principles. But it does take a firm stomach to buy into. When the markets are crashing, it takes a strong stomach, strong constitution to buy into that. But over the long run, if you're the patient long run investor, you'll be rewarded in an expected sense. I'm not guaranteeing anything here. we do. No one has the crystal ball. So, but statistically, the stats is on your side for being rewarded. Okay, yeah, so good point. Any other points you want to make? Because, yeah.
We have quite a few questions.
Good.
They're not in sequence. Somehow the order seems to be off. So I apologize if they're not coming out in the order that you guys submitted them. But I can go over them, and John, you can answer as well.
I'll try and give quick answers given the,
yeah. We've got quite a few questions. So the first one,
I'll try and give real quick answers then.
Okay. So the first one is, how can one safely do the capital allocation keeping risk in mind? How do we predict that this is the low and the right time to buy?
First observation, timing the market is, no one really has a good track record of timing the market. So predicting the timing is not good. Statistically, you can sort of look at sort of what the averages are and all of that. And basically, when you really get into it, that last column was smart beta type portfolio. So you're going to combine fundamentals as well as sort of prices and such to really do that. But beware about trying to time the market. I mean, only to the extent that if there's a massive overreaction to an event that you think it's not the end of the world. These markets will recover maybe 2, 3, 5 years down the road. Then you'll be rewarded. Okay, that's the timing of the. Warren Buffett tends to buy in recessions. That's good timing of the market. But his investment horizon's 10 years. The average recession, 18 months. The average expansion, 7 years. So if you've got a long time horizon, then you can time the market.
And I think a couple of other strategies. Some people use technical analysis, so they will look at charts and try to predict. So they'll decide where to invest, and then they look at charts and try to get the timing right. But like John said, that if you're looking at a 10-year horizon, then timing today or in 2 weeks, if markets are not going through some drastic changes, it's going to be marginal, the impact. You may not make as much money, but you'll still make money because on average markets move up. So if the cycle period is right, then you'll end up making money. John, we'll move to the next one.
Yep.
How do you figure out the intrinsic value of the company? And the second part is keeping minimum risk in mind. Do you suggest to go with large cap companies?
Okay, the first part of that question, intrinsic value, you have to do the fundamental analysis. And just really briefly, the key 3 variables are projecting out the future dividends, the expected dividends, which tends to be driven by earnings, and assessing the growth. I can't really answer this in like 2 minutes here. It's a whole course, but you have to look at the fundamentals. So you're combining finance and accounting, actually, to assess the intrinsic value of a company. Sorry, what was the second part?
So someone who's extremely risk averse, keeping minimum risk in mind, you suggest going with large cap companies?
Yeah, minimum risk in mind. You're trying to reduce the volatility of your portfolio. So yeah, that one you can sort of look at sort of the volatility, which is really just the variance of the returns over history, and the large caps, and maybe throw in some government bonds to reduce that risk even further. Yeah.
So other than large cap, you can also look at an index and just go with an index. If you're extremely naive about the market and you're not actively participating, an index would be an easier way to get in, and the QSE has ETFs as well. So that would be one of the ways to go.
And they are broadly diversified portfolios. But it's but the really risk averse are going to sort of do a bit of the market and government bonds and sort of combine that.
Next question, similar to this one, keeping long-term investment horizon, what do you suggest to focus on, large or small cap market?
Good question. Good question. Probably both, actually. I mean, if you look at the US example, where was it? Back here. Now, the large definitely for long term, because the large stocks are much more likely to be around 10 years down the road. The small caps, you have to, I'd be looking, you'd want to do some sort of fundamental analysis on them. If you can get a whole large set of small caps, that's fine. Now, the US offer that sort of thing, like Russell 3000 and that. You've got about 2,000-3,000 small stocks. So you have to be careful with small stocks. Recall that even in the US, they had twice the volatility of the large stocks. So they're going to be a lot riskier and the returns are going to be a lot higher. So when there's a smaller number of small caps, I would say you're tilting more of your weights to the large, but keeping a smaller proportion of your weights in small. Yeah, get a bit of both worlds. But you have to watch your small ones a lot more closely.
Right. The next one is, do you believe Qatar market has a strong financial sector to diversify in?
Yeah, Qatar's been very successful in diversifying their economy. And I mean, the driver has been obviously liquid gas. But then what did Qatar do? They built a really strong financial sector. So 2008, actually, QNB was the strongest bank in the world, actually, in 2008. And there are only two countries where the banks maintain their AA rating, and that was, strangely enough, Australia and Qatar. Australia, I think, got lucky. They were the government had blocked them from investing in all that risky stuff, so they got lucky. But the banking sector in Qatar, stellar performance compared to the rest of the world in 2008. Solid, yeah, good sector.
Next one.
That's a personal opinion. I'm not speaking on behalf of the university, so I'm not going to say that. That's a personal opinion.
Is the ultimate form of diversification to invest in index funds? I think we've kind of answered that.
I think we've kind of answered that, yeah. I mean, diversification is all about managing unsystematic and systematic risk. If you think index funds are your best way of doing that, fine. If you want to form your own portfolio to do that, fine. Yeah.
Next one. If we have long-term investments during a crash, should we exit the investment and buy again at lower price, or should we keep investment all the way and add more when the price drops? So it goes back to timing.
Yeah, long-term investments, that I prefer that latter one, because once you exit the investment, you have realized a loss that now you're in that vicious cycle. So I don't. I mean, I much prefer that latter strategy of not exiting and buying more. If you're viewing your long-term investment as still sound and they haven't gone bankrupt on you, buy more.
Okay. This one, what happens to a company that generates profits and has a strong name, but does not move up or down, as there's very little trading? So
liquidity. Yeah, liquidity is an issue. The reason a property is not going up and down and a little trading, it means it's very tightly held. And but if what you're saying, if the fundamentals are strong, you just have to sort of build up your position in it over time, because you have to. Sometimes it takes a few weeks to build up a position to a desirable level. It may take a month if it's very tightly held, but its long-term prospects are probably pretty good.
Thank you. Next one is, can we reduce systematic risk? And if so, how can we reduce the chances of systematic risk occurring in relation to our own personal diversified investments?
Okay, the classic ways of reducing systematic risk, which I spoke about one today with Markowitz diversification, but also diversifying globally is another way of reducing systematic risk. So, because think about it, countries like Qatar and Australia, they tend to be very resource rich, okay, natural resources. A country like Germany, it's going to produce good cars. So, there's sort of an approach which is called a global sector approach. And so you're diversifying across those sectors, but you may be putting it in some countries that are better in some sectors than other countries. So that's the way of reducing. And
now we have ETFs. Globally, we have ETFs that are across countries, not just local to one economy. But still, there would still be some level of contagion. So if something massive happens in one country, there could still be spillover and effects all over. 2008, for example.
Yeah, you can never get rid of systematic risk. The only way you can get rid of systematic risk completely, you have to pay for insurance, but that's a different topic. Derivatives are one way, but you're going to take reduced return because you're paying for the insurance. But otherwise, and it's not necessarily even a good strategy. Just holding long-term diversified portfolio, it rewards. Because systematic risk tends to recover over time.
There's another question. As we can see in the last 3 months, the market cap for most companies has been fluctuating. How accurate is the P ratio when valuing a company during this pandemic, or I guess any crash or any sharp movement? So
Yeah, the PE ratio is the most quoted ratio out there. But as you observe, when the market's fluctuating a lot, PE ratios are going to fluctuate a lot. So my bias is in the fundamentals as opposed to just looking at a price ratio. It's a quick and dirty approach to assessing a stock, but you really want to, if you're looking at the fundamentals, you go well beyond just PE ratios. So I agree. When they're fluctuating like that, they're probably not as relatively meaningless. Although long-term averages do count. PE ratios tend to mean revert. So when they're high, they come back down. When they're low, they tend to go back up.
So another question. This is more on the application. How was risk calculated? Standard deviation of what? How long of a
deviation of return? Yeah.
So how long a time frame to take? And so if someone wants to run the same exercise at home, how do they go about doing this?
Yeah, that's a good question. My usual answer to that question is, if your investment horizon is 5 years, I'd run it 5 years. If your investment horizon is 10 years, I'd run it at least 10 years. So I tend to try to match my, but I can't give you a unique answer to that one. It's the statistics really, but you want at least 5 years of, a standard is 5 years of monthly return data is probably the standard out there, I think, in finance for estimating volatility. Sometimes you may want to look over 10 years. And if they're similar, if it's changing a lot, then you look at the fundamentals. Why is it changing? And there are fundamentals related to risk as well. But 5 years monthly is standard, I suppose.
And definitely don't go for daily because there's a lot of noise there. So.
Yeah, don't go for daily. Yeah, a lot of noise. Yeah, a lot of noise.
So there's another one. Okay, this is a long one. This person has been allocating monthly funds to purchase stocks, but with returns being so inflated due to stocks more than having in value in just a couple of months ago, it's hard to gauge what we should really be looking to do in a post-pandemic world in terms of investing. So the question is, what advice would you give to newer investors who are used to seeing 10, 20, 30, 40, even 50% positive returns on purchase in such a short amount of time? Yeah.
Well, I mean, the first thing you mentioned in that question is allocating to the market on a monthly basis. That is, I think, one of the best ways of doing the market, actually, especially for your long-term retirement funds. You're not trying to time the market. You just agree, you just pre-commit to allocating on a monthly basis. Now, the second part, obviously, very realistic with your return expectations. I mean, you can be lucky and get massive returns, but look at the long-term averages and they'll give you a better sort of estimate of what to expect. So like in the US market for long-term stocks, what did I say, the growth, the CAGRs were about 10% over the long run. And it's probably not a whole lot of difference to other markets over the long run for broadly based portfolios. But there is a puzzle out there, and it's a puzzle that's on your side. In economics, it's called the equity premium puzzle. And the puzzle is, how come stocks give a much better return than bonds than what the theory can predict? And that's gone on for hundreds of years. So, and if it suddenly went away, you're still rewarded because the present value goes up. So stocks are a good investment over the long run, worldwide.
John, we have 8 minutes to go, so I don't think we'll be able to get through all the questions. So I will just continue for now.
Yeah.
So they've written, I'm seeing a lot of content online pushing for people to start getting into investments now since the market is bearish. Do you agree with the statement? Do you think it's basically, is it a good time to invest right now?
For the following reasons, I would say yes, because the pandemic has impacted the market big time, and we expect that the pandemic will be eventually solved by the medical world. So yes, even though the short term, yeah, it could go anywhere. But as long as your horizon is longer than 2 years, yeah.
And one more thing on this. So John has mentioned earlier that, you know, your age group also drives the nature of investing that you undertake. So if you are close to retirement, then you want to go with safer things like maybe bonds or risk-free assets. If you are younger, you can take on more risk because you can ride out cycles. So if your retirement is in 2 years, you don't know if the markets would have picked up in 2 years. So you can get seriously hurt in the market if you invest in stocks now. But if you have a longer term horizon, 5 or 10 years or longer, then stocks would be the way to go.
Yeah.
So are stocks like S&P 500 considered naive diversification, or is it only separate equal investments in that are considered?
Yeah, no, naive diversification is equal weights. The S&P 500, the weights are different stocks have different market caps. So the largest few stocks, I mean like the ones that are around $1 trillion or above, like the Microsofts, the Apples, the Amazons, they're going to have a much larger weight in the S&P 500 than some smaller stock. So they're unequal weights. They're market determined weights.
Next one is, do risk-free investments still provide return during recessions or during other systematic risk events, I guess?
Yes, they do, but the current now bonds in Qatar are giving a higher rate than bonds in the US, but the short end of the yield curve of in many countries is almost around 0 at the moment. So the longer term bonds, the risk-free investments give you a low rate of return at the moment. That's because interest rates are very low. So it's a risk-return trade-off. I mean, for some reason, like in the US market, you can do better out of dividend yields than you can out of bonds.
And someone's asked if this webinar will be recorded, and we said yes. You can get in touch with the stock exchange, and they will tell you how to find it.
Yeah.
The next one is, what advice would you give investors looking forward to investing in the QSC in the present state these days?
No, well, I mean, yeah. I mean, if your horizon is if your horizon is not short term, then right now,
Go with the diversified portfolio, probably an ETF, some sort of a fund. That would be a safe way to go.
Yeah, I mean, Qatar is expected to grow, and so if Qatar's economy is expected to grow, the stock market will grow. That's your way of benefiting from growth in the economy.
Then, given that doing a fundamental analysis on small stocks is a bit hard, as they're in growth stage and profits are minimal, how would you go about picking the right one? What's the right approach to pick that next Amazon or Apple, other than luck?
My quick answer to that is you don't try to pick the right one, you form a portfolio. And there are ETFs that specialize in that in the US, and you can mimic the same there. So don't put all your eggs in the one basket. Otherwise you run the risk of a minus 100% drawdown.
So this one says, this one's asking, if everyone is diversifying their investments or buying the index, how does one create an edge over others? Basically, how do you make more positive alpha?
Well, the positive alpha, I mean, yeah, it gets back to your fundamental analysis. You vary the tilts. So you know what the index weights are. The only way of actually creating an edge is to vary those weights. But you are working, I mean, it's, I I mean, well, there's another way. I mean, financial leverage is one way, but that increases the risk. Really, the only way you can do it is to increase the risk. It depends on your risk tolerance. If you want to take on more risk, yeah, there are ways of beating the index, but you have to increase the risk.
And if you're new to investing, or if you're not a very active investor who's constantly following markets, I think, again, a fund is an index fund or an ETF is the way to go.
Yeah, exactly right.
Don't try something fancy because that's very risky.
Yeah. Certainly serious wealth too. you don't want to throw it too risky.
Someone's asked, how can I study or understand fundamental analysis? Can you please advise? Oh, that's a long discussion and difficult to do it in 2 minutes. There are books out there.
There are a lot of books written on it. In fact, one of the books that introduced me to it was there are books on sort of Warren Buffett's approach. Actually, that's a good starting point for reading. It's not the ending point, but there are some. There are a lot of books out there on fundamental analysis. But again, a lot of it's common sense. It's three basic variables: forecasting out the future dividends, forecasting out growth, and forecasting out cost of capital. But we can't elaborate on that in this session.
So John, I think in the interest of time, just one final, I think it's more of a comment. Can we have a part 2 soon in the future? I really love this seminar and would love if we can touch up on other topics like smart beta.
Yeah, we could. Well, it's up to the QSC.
Sure.
We hated this.
I believe this will be a great pleasure to us to have another session with you, because today it was very, very, very informative, interesting, and I personally learned a lot from this webinar. So thank you very much, and I hope that we can have another one or a part 2, like Ahmed asked.
And I apologize to all the people who had questions because we've run out of time. So maybe in the second one we can catch up on things.
That's I'm quite happy to be involved in part 2 too. And what I would suggest is, we allow more time for the questions. So maybe it's like a 50-50 type of thing, and throw it open to the more time for the questions. Yeah.
And that's more on us, I guess, that we shrink the content and we keep an hour open maybe for Q&A. And once again,
when you let professors talk, they never want to shut up.
just in closing, the advice we've given has generally been just pure advice. So we're not saying that go for something or recommending some share. The examples we gave were just examples we picked up. So I just wanted to be clear on that.
Yes, we all qualify that part, that this was educational purposes, not sort of giving you investment advice. We're giving you conceptual advice. And
okay, thank you very much, John. Thank you very much, Fuad, for this informative session. I actually enjoyed and learned a lot, as I mentioned, and I will start to work on my efficient frontier from tomorrow, inshallah.
Good.
And I saw many comments in the chat and in the questions asking for the recording, which means that everyone enjoyed and was interested. So I will send, as an exceptional, this time, I will send a link to the recording on Zoom for the attendees after, maybe tomorrow morning, inshallah. And it will be valid for 1 week for everyone to watch the recording. So I will edit the video on Zoom and send the link to everyone attended, and you can watch the recording. Of course, I assume that Fuad and John are happy with this. Okay with you?
Sure. Yeah, that's fine. Yeah, that's fine.
Okay. And again, thank you very much for the speakers. Thank you for the attendees. And I hope that we still have 10 webinars to go this month. So please visit our website. You will find all the details of the webinars. We still have, I think, fundamental analysis, financial analysis, technical analysis webinars, also something about listings and how to list in the Qatar Stock Exchange, investor relations, digital investor relations, especially in this circumstances. So we have very interesting webinars coming this month, so please visit our website and register, and we are always happy to have you. And now we have a promise from our great professors to have a part 2 session, inshallah. So hopefully we will coordinate it and we'll announce it, inshallah, soon. Thank you very much, and hope to see you, inshallah, in our coming sessions.
Bye.
Thank you very much.
Bye-bye. Thank you.
Thank you.
Bye. Bye.